I'm Ellis Martin with an editor's note for the Ellis Martin Report. Usually when I do a phone interview with our guest analyst and sponsor companies, I'll spend time editing it down, sprucing it up, taking out long pauses and gaffes, etc. In fact, I'll even re-record some of the questions for the sake of clarity in order to provide you, the listener, with a concise piece for review. Well, this takes quite a bit of time, and today there's no time for that. Not with this message from Mr. Sinclair. It's fairly urgent and very newsworthy. Therefore, breaking tradition here, you will hear an unedited interview between Jim Sinclair and myself about the impending non-declared bankruptcy of 5 U.S. banks, perhaps this week. We're essentially going to float the Eurozone and the Euro. This may be the only place you'll hear this news, and at least perhaps the first. Here's my interview with Jim Sinclair, dated today, January 30th, 2012.
Ellis.
Good morning, Jim. How are you?
Doing pretty good.
Excellent.
Just a wild morning with things I had to do.
Okay. Well, Mondays are Mondays.
They always are, aren't they?
Yes, sir.
I got news for you. Nobody knows what running a business is like. Okay?
I hear you.
It's not a question of what you produce in terms of ounces or earnings or mines or whatever. The day-to-day running of a business is without a doubt an undertaking that if a person wants to do correctly, he should go to bed first and try and see if he forgets about it. But that being said, I think I got a great interview for you. I got an important interview for you today.
Great. What do you want to talk about?
I want to talk about the ISDA, the International Swaps and Derivatives Association.
Okay.
For the people who determine whether a credit event is a default or not.
Okay.
Who they are and what it means.
Okay, well, let's do it then.
Well, nobody's talking about it. It is the singular, most important organization with more power than governments. It will determine whether 5 U.S. banks go insolvent tomorrow.
We're talking tomorrow, as in Tuesday or Wednesday.
I'm talking this week, as in what the final arrangement will be governing the amount of payoff on Greek debt.
Are these big American banks you're talking about?
The five of the largest U.S. banks control 97% of all the credit default swaps.
Okay, why isn't this in the so-called mainstream media right now?
Media blackout.
Really?
Absolute.
And the market's almost completely unaware of it. I mean, the market.
Well, the market is oblivious of it. Even though the decision they'll make will certainly be in their favor. The question is, how do you do it with a straight face?
How are you doing it with a straight face?
I'm just ISDA governs whether or not a credit event would be called a default. If it's called a default, then the credit default swaps have to function. The credit default swaps are a type of insurance offered by to interested parties, guaranteeing the sovereign debt. 97% of the guarantee of the sovereign debt is held by 5 of the largest U.S. banks.
So
they're basically writing insurance, getting paid for insurance. They are the control of the ISDA. So obviously, if what everyone expects to happen happens, and the Greek debt is haircut down to 30%, how do you declare that not to be a default?
So Greece, with the population of 11 million people, is setting off this potential default here with 5 U.S. banks.
If the ISDA determines the credit event to be a default, which obviously they won't. The question is, how in the world, if you get paid back 30 cents on a dollar, have you not been defaulted on?
So it's bankruptcy.
If the ISDA declares it to be so.
Okay.
The ISDA is the organization, International Swaps and Derivative Association, is the organization who who defines what a credit event is.
So this is an arbitrary decision that may be made.
It's an arbitrary decision that in all probability will not be made. But it's the contradiction is, if you're getting back only 30% of an investment, how in the world do you not consider that a default? Must a default be zero?
This news is a little bit unsettling, at least to me, and I try to follow everything. You know more than most people, being who you are. And
well, I've been in this stuff for over 50 years.
Well, we're gonna publish this interview fairly soon, and everyone's going to hear it. A lot of people are going to hear it. And
who will determine the fate of five major U.S. banks? Is the five major U.S. banks, which heavily influence the organization that decides and defines what a credit event is internationally.
So the banks are determining their own fate.
And therefore, what are they going to determine? Not a default.
All right. Well, then, are we just continuing to pour gasoline on the fire here,
or of course we are, because what is a default? And this is who determines what a credit event is? Determines whether or not credit default swaps have to come in, are called into action. The International Swaps and Derivatives Association is the body which will determine what a credit event is. If a credit event is determined to be a default, then the five banks that are holding 97% of the CDSs, credit default swaps, would be insolvent.
Well, certainly they're not going to let themselves.
They're not going to. Not. But okay. The point is that all it does is weaken the system on a constant basis, because many people have taken the trade where they're long the euro bonds, and they've bought credit default swaps to protect themselves in a spread. Now, this is how MF went broke. MF went broke on the 50% haircut. They had bought credit default swaps, but the International Swaps and Derivative Association said that the 50% haircut is not a default. That took MF out.
Well, if the
who's going to be taken out when the 30% is declared not a default?
What's left?
Well, the question is, what is a default? I mean, if it gets to zero, the ISDA is going to have a hard time saying it's not a default, and then they go. We've sold worthless paper as an occupation called over-the-counter derivatives, which is responsible for the huge profits and bonuses made in Wall Street. Rather than learn their lesson, the banks have gone wild on issuing credit default swaps. 5 of the largest U.S. banks have issued 97% of the amount of credit default swaps outstanding. There's an organization called the ISDA, which will determine arbitrarily whether or not a credit event, a new word they've created, is or is not a default. The 50% haircut on the Greek debt was originally determined not to be a default. When it was determined not to be a default, the ones who suffer are the ones who thought they had insurance, because the ISDA determined that the credit default swaps did not have to insure the haircut to 50%. Today, all we hear is that that the probability of a further haircut on the Greek debt to somewhere in the area with a 3 in front of it, possibly 30% repayment on the debt, is about to be agreed upon. If it is, what will the ISDA say? Will they call that a default? Well, the ISDA is made up of the member banks who could suffer the most if it is called a default. Therefore, it's reasonable to assume that in the great wisdom of the ISDA, a 30% repayment is not a default. Therefore, it has to have repercussions amongst those who have hedged themselves using the credit default swap.
Which are?
All the guys just like MF that just went bust at the clearinghouse because they thought they had a riskless trade, having purchased the euro debt and insured themselves by purchasing a credit default swap.
So all the rest of these clearinghouses, these major clearinghouses,
anyone else who's using other people's money, and that's what they basically were doing, to speculate on these instruments, has tonight a very serious problem.
And no one's backing these clearinghouses.
No, and the worst part is that all this is doing is stalling off the time when that debt may be zero, and the ISDA cannot say it isn't, that a default didn't occur. in which case we're in worse shape than we were in 2008.
Is that a timeline for this year, do you think?
The timeline for a collapse of the euro, and one of the reasons why the euro collapse will be fought so hard. But it's an event that can take place, because certainly 50% of default, certainly 30% of default, and when it gets to zero, what in the hell are they going to call it but a default? In which case they self-emulate. I mean, anyone who thinks that the system out there is without risk right now is just totally out of their minds. It's more at risk right now thanks to the credit default swap than we were in 2008 due to the over-the-counter derivatives written on real estate.
Well, that's untenable risk.
It is untenable risk, but you go on Google, put in International Swaps and Derivative Association. This industry association is more powerful than any government.
Well, what is the risk to our listeners, to folks listening to this program right now?
A repeat of 2008, but worse. In other words, the risk to the listener is having to go through a second financial crisis, requiring significant financial intervention equal to or larger than what's already taken place.
Can that happen?
Sure.
Can a rescue happen?
It can print paper, but there's consequences.
Will that happen in an election year?
Every single effort would be made not to allow it to happen. So we are going to go now to a 30% haircut, not being a default. But you see, by doing that, we're doing the exact same thing as when the real estate market was constantly declining, and everything was being done to consider these things AAA rated on your securitized real estate investments. But you play this game, and there is an end. There's an end point to the game, because you don't all you're doing is plugging the hole and not doing anything to make it right. There's nothing going on that's going to make Greece right. Greece will it's gone to 50%. It's gone to 30%. Yeah, it probably will go to zero. Then what?
The dollar strengthens. The gold pulls back, corrects, but yet ultimately all this downward pressure on gold.
The dollar goes in the ash can because you got to go to a global quantitative easing.
Well,
there's no tool to fight this but QE. QE is dollar negative, not dollar positive.
Well, you predicted a QE3 will happen this year.
And it's been announced last week.
Yes.
As absolutely happening. So what you're going to do now is, people don't understand the fragility of the system. And you're going to paper over one more time because, yes, you're right, not only in an election year can't this happen, but if it was papered over at 50%, they'll paper over it again at 30%. The mechanism is the ISDA will declare the credit event not to be a default.
So this will be a quiet papering.
Yeah, but all you do is you're marching forward to a point where there's nothing further you can do.
So unlike 2008, where the paperings, the quantitative easings were big news stories, this one won't be. This
will be a news story, but it will be a news story as if everything has been made relatively okay again, because the ISDA will declare the credit event about to take place not a default, which further weakens the system.
So the news hype about the quantitative easings in 2008 had to be political, helping the party that won the office.
It had to come out ahead of this thing, because quantitative easing is good for your equity markets. And the reason why the equity markets aren't performing is that there are enough people around who understand what in fact is taking place. But QE is extremely good for equities.
Precious metals.
Equities.
Equities in general.
Equities in general.
Well,
Netflix.
Netflix.
I mean, not particularly, but I'm just saying QE. The grease of the wheels of the equity markets has always been liquidity, and the grease of the wheels of the equity markets will always remain liquidity. And what's good for gold right now is equally as good, if not better, for general equities.
So
the fact that general equities are not performing spectacularly